Welcome back to Smart Stock Sam, the channel where we cut through the noise, skip the hype, and go straight to the hard truth so you can trade with real confidence. I am your host, Sam, and today we are going deep on one of the most controversial AI stocks trading right now, BigBear.ai, ticker symbol BBAI. You clicked because you want a real answer. Is this a dead cat bounce, or is the next massive squeeze quietly loading? By the time we finish, you will have that answer backed by real data. We are walking through the fundamentals, decoding what smart money is doing, reading the options market signals, mapping exact technical levels, and handing you a specific trade setup for the week of June 22nd. If you are holding, thinking about entering, or just trying to understand why your feed will not stop talking about it, stay locked in. But before we can understand where this stock is going, we have to establish exactly where it stands today. BBAI is currently sitting at $3.92 per share. It posted a tiny daily gain of roughly 1%, but the moment you zoom out even slightly, the picture gets far more complicated. The stock is actually down 5% on the week, significantly underperforming the broader market during a period when major indexes have been grinding higher. What you have here is a genuine tug-of-war happening in real time. On one side, flashing technical warning signals and a massive army of institutional short sellers betting against this stock every single day. On the other side, a passionate retail community convinced that this sub-$4 level is one of the most compelling buying opportunities of the year. Our job is not to pick a side based on emotion. Our job is to synthesize the technicals, the options flow, and the fundamentals to give you the clearest, most logical picture of where this stock is most likely heading in the next few trading sessions. And what we find is not what most people are talking about. When you look at BigBear.ai's first quarter numbers, the headline figure looks almost boring. Revenue came in flat at $34.4 million, down a fraction of a percent year over year. For a company operating in the hottest technology sector on the planet, that kind of top-line stagnation sends growth investors running. But here is what those investors are missing. Look at the backlog. Their sequential contract backlog surged 14% to a staggering $281.9 million, fueled massively by a brand new $53 million sole source classified intelligence contract with the defense sector. $281.9 million in committed future work sitting on the books. That is not nothing. But before you get too excited, there is a critical development that fundamentally shifts the risk profile here. At their June 9th annual meeting, shareholders voted to double the total authorized common shares from 500 million all the way up to 1 billion shares. 1 billion shares. That is management handing themselves the legal authority to flood the market with new stock whenever they choose. Every time this stock attempts a meaningful rally, the market is going to be watching that dilution authorization sitting in the background like a ceiling, quietly capping the upside. This is the hidden risk the bulls in comment sections are not talking about. However, buried inside those first quarter numbers is one metric the bears are almost entirely ignoring, and it changes the entire conversation. BigBear.ai just delivered one of the most impressive gross margin improvements you will see from a company of this size. Their gross margin expanded dramatically from 21.3% up to 34.0% in a single quarter. How does a company with flat revenue suddenly become nearly 13 percentage points more profitable on every dollar it generates? The answer is their proprietary generative AI platform called Ask Sage. Management is actively shifting the revenue mix away from lower-margin consulting and legacy services toward high-margin, scalable software. Because of this structural improvement, management reaffirmed full-year 2026 revenue guidance in the range of $135 million to $165 million. The top line looks stagnant to the untrained eye, but the quality of that revenue is quietly transforming beneath the surface. Still, even a more profitable version of BigBear.ai as it exists today has a ceiling, which is exactly why the company just made a move that could either be a masterstroke or a catastrophic distraction, depending entirely on execution. Enter the LivePerson acquisition. BigBear.ai has historically been a defense-first artificial intelligence company, voice analytics, computer vision, decision intelligence, all sold primarily to government clients. These contracts are stable but move at a glacial pace. By acquiring LivePerson, a company with a broad commercial enterprise customer base built around digital messaging technology, BBAI is attempting to bridge its government credibility directly into the commercial market at scale. This is not a bolt-on deal. This is a transformational bet. The stated combined revenue target is between $350 million and $400 million annually by 2027. If they execute this integration without burning through their cash reserves, this company looks entirely different in 18 months. The word "if" is doing a tremendous amount of work in that sentence, and we will come back to it. Right now, though, let us look at what the actual smart money is telling us. Institutional investors control approximately 44.89% of the float, and what makes this so fascinating is they are violently disagreeing with each other. BlackRock, the largest asset manager in the world, increased its stake by 45.8% and now holds over 31 million shares. Vanguard quietly added another 5 million. These are the most methodical money managers in existence, and they are buying. But sophisticated quant funds, including Renaissance Technologies and Jump Financial, have completely liquidated their entire positions. Gone. Zero. When firms running the most advanced algorithmic systems ever built quietly exit, they are telling you something. And the insiders, executives who know every contract and internal projection, over the last 6 months, insiders have only been selling on the open market, totaling hundreds of thousands of dollars, with zero open market purchases to offset it. The one silver lining is that the board was just granted substantial new restricted stock units, tying their compensation to future share price performance, but the people closest to this business are not putting their own personal money in at current levels. That is a data point you cannot ignore. This divide between institutional bulls and quantitative bears, combined with insider selling, is precisely why Wall Street analysts are arriving at completely opposite conclusions when looking at the same stock. The price target spectrum is genuinely chaotic. Zacks currently carries a sell rank. Why? Because the consensus 2026 earnings loss estimate widened from 9 cents per share out to 18 cents per share over just the last 2 months. The quantitative systems are waving red flags. And yet, on the fundamental analyst side, Cantor Fitzgerald has a price target of $5 even. Simply, Wall Street models the fair value at $5.33. H.C. Wainwright has a buy rating with a target of $6 even, against a current price of $3.92. That is over 50% implied upside from some of the most credible names covering this company. The bull case and the bear case are both sitting on the table simultaneously. Which side you believe determines everything about how you approach this trade. So if the fundamentals are this contested, we turn to the cold, hard, unemotional language of the charts. From a purely technical standpoint, the signals are not encouraging. BBAI is currently flashing a strong sell signal, trapped in what chart technicians call a dead cat bounce, a temporary, low-conviction rebound happening inside a deeply established downtrend. The stock is trading below its 20-day, its 50-day, and its 200-day moving averages. That is textbook bearish alignment across every primary time frame. The only thread the bulls are hanging onto is the short-term 5-day moving average sitting at $3.87, acting as an immediate floor of support. Momentum oscillators offer no relief. The RSI sits at a neutral 46, and the MACD remains planted in negative territory. Any bounce you see right now is fighting against the prevailing current, not riding with it. Zooming into the specific price levels, the stock is navigating a tight liquidity channel near $3.92. Immediate downside support sits at $3.84, with secondary support at $3.81. On the upside, resistance layers stack at $3.89, $3.91, and ultimately $3.94. The market makers have boxed this stock in, waiting for a catalyst to force a violent, decisive break. The question is, which direction? And here is where the most explosive potential energy in this entire trade is hiding. Pay very close attention to these four numbers. First, short interest is sitting at 26.95% of the float. That is over 128 million shares sold short, each one of them legally obligated to be bought back at some point in the future. Second, dark pool volume has been sustaining above 41%, meaning large institutional players are moving significant size in off-exchange hidden venues without showing their hand publicly. Third, the cost to borrow shares to maintain a short position is ticking higher, now sitting at 2.28% tier, meaning carrying the short is getting more expensive every single day. And fourth, the one that matters most, the days to cover ratio sits at 5.04. That means if every single short seller decided today that they wanted to close their position and buy back their shares, it would take them over 5 full trading days of average volume to complete those purchases. 5 days of relentless forced buying. Can you imagine what that pressure does to a stock sitting below $4? That is the coiled spring. One genuine positive catalyst, and this thing does not walk higher, it launches. And the options market is screaming that retail traders have already figured this out. The options chain expiring. Friday, June 26th is one of the most lopsided, revealing setups you will find anywhere in the current market. The put-to-call volume ratio sits at just 0.30, meaning for every single put being purchased by bearish traders, bulls are buying over 3 calls. Implied volatility is running in the range of 53 to 66%, well below the historical norm of 76%, meaning directional bets are currently inexpensive relative to how violently this stock actually moves. And the open interest tells the real story. There are 2,400 contracts at the $4 call strike, over 4,000 at $4.50. and 4,500 contracts sitting at the $5 strike. Retail is loading up on out-of-the-money lottery tickets targeting a breakout. But every single one of those contracts expires worthless unless the stock can break through one specific critical level. Everything hinges on $4 even. $4 is not just a psychological round number. It is the 50-day moving average. And it is the precise price point where the maximum convergence of put and call open interest creates the gamma pivot. Here is why this matters. If BBAI breaks above $4 and holds with real volume, the market makers who sold all those call options face a mathematical problem. To hedge their own risk, they are required to dynamically buy shares of the underlying stock in real time as the price moves higher. A process called gamma hedging. Those forced purchases push the price higher, which triggers more gamma hedging, which pushes the price higher again, and the loop accelerates toward the next call walls at $4.50 and $5. However, if the stock fails to reclaim $4 convincingly, momentum collapses, the shorts sense weakness, and the path of least resistance becomes a slow grind down toward the heavy put support sitting at $3.50. Before you place a single trade, monitor 3 specific things. First, backlog conversion. $281.9 million in backlog is a great press release, but BBAI must convert those contracts into recognized revenue faster than their cash burn forces them to use that billion-share authorization. Watch the conversion rate every quarter. Second, the LivePerson integration. Every public update, every operational milestone, every partnership announcement needs to show concrete progress toward that $350 to $400 million combined revenue target by 2027. Vague management optimism does not count. Specific, verifiable steps do. Third, the $4 gamma pivot on your chart. Either the stock breaks above it and holds, and the mechanical squeeze ignites, or it does not. This is the single most important number you need to know this entire week. Now, let us bring every piece of this together into one clean, executable plan. Based on the 27% short interest, cheap implied volatility, and the call-heavy options flow, the setup for this week is a cautiously bullish, mean reversion, potential gamma squeeze play. Entry zone is between $3.85 and $3.92, accumulating near the 5-day moving average while it holds. Risk management is non-negotiable. Your hard stop loss sits at $3.75. If the stock breaks decisively below the recent swing low of $3.76, the thesis is voided and exposure to $3.50 becomes real. On the upside, your first take-profit target is $4.02, clearing the gamma pivot and the call wall. If it slices through that on heavy volume with conviction, your secondary target is the range between $4.35 and $4.50, where the next major short covering and gamma pressure zone sits. Entry zone, hard stop, 2 targets, clean, specific, logical. Now, before the final conclusion, the most important thing I say in every single video: nothing you just watched is financial advice. I am not your financial advisor, broker, or licensed investment professional of any kind. Everything in this video is purely educational content based on publicly available market data. Every trade carries real risk of real loss. Technical setups, short squeeze mechanics, and analyst price targets are never a guarantee of future price movement. Please do your own research. Consult a qualified financial professional before making any investment decision, and never risk money you cannot afford to lose. The market can stay irrational far longer than any position can stay solvent. That is not a formality. It is the most important thing I say. BigBear.ai sits at a genuine inflection point, and I want to give you the honest picture on both sides. For short-term traders, the roadmap is clear. Enter carefully in the 385 to 392 zone, protect yourself with a hard stop at 375, and if the stock breaks and holds above $4 with real volume behind it, ride the gamma squeeze toward 435 and beyond. For long-term investors, the math is more nuanced. You are balancing the genuinely impressive margin expansion happening with Ask Sage, a $281.9 million backlog proving real demand, and an ambitious path toward $400 million in combined revenue, all against the permanent shadow of that 1 billion share dilution authorization hanging over every rally attempt. The underlying business is getting stronger. The risk profile just got significantly more complicated. Both things are true at the same time. Now, I want to hear from you, and I mean this genuinely. Think carefully before you answer. If BigBear.ai successfully integrates LivePerson and hits that $350 million revenue target by 2027, do you believe management would actually resist the temptation to dilute shareholders under that 1 billion share authorization? Or do you think the dilution is essentially inevitable no matter how well the business performs? Drop your real answer in the comments right now. I read every single one, and I want to see a real debate break out in this community. If this analysis gave you clarity or saved you from an emotional trade this week, hit the like button right now. It takes 2 seconds and helps Smart Stock Sam reach more investors who need honest, data-driven content. Subscribe and ring the notification bell so you never miss an analysis when it matters most. And if this video delivered real value today, consider sending a super thanks through YouTube's support feature directly below. Every contribution goes straight back into making this research deeper and this community stronger. Smart Stock Sam membership is officially live. Members get exclusive, deeper analysis, trade setups before they go public, and priority support to make smarter market decisions. The link is right below. Come join us, because the best trades are always made with better information and a stronger mentor around you. This is Smart Stock Sam. Manage your risk, stick to your levels, and remember, the market rewards preparation, not hope. I will see you in the next update.